Extrinsic value, brought to you by Probability Trading. Hello traders, this is Dr. Jim, bringing you another lesson in your journey towards options trading. Today's lesson is extrinsic value. Let's review. The total premium paid or received, depending on if we're buying or selling the option, consists of both intrinsic and extrinsic value. Intrinsic value is simply the difference between the strike price and the stock price for a call. The intrinsic value for a put is the opposite, because remember, a put is basically a short position. So it's the inverse, the opposite of the call. So the intrinsic value for a put is strike price minus the stock price. Let's take an example for intrinsic value. Here's one using General Motors on June 27th. The stock price is $34.78. We're going to buy a call with a strike of $33. So the intrinsic value is $1.78, $34.78 minus 33. This may not be the premium. The premium is going to be higher, but this is the intrinsic value. For a put, it's exact opposite. It's going to be the strike price minus the stock price. $1.72 because we got $36.50 is our strike price. $34.78 is the stock price, giving us $1.72 of intrinsic value. This is money that's already built into the option. Nothing you can do. It's there, it's calculated. It's not where our money is. We're going to make the money on the extrinsic value. So what is extrinsic value? Why, it's everything else. The premium paid equals the intrinsic value plus extrinsic value. In the previous example, I showed you what the intrinsic value was. However, the premium did not equal the results above. If you subtract the intrinsic value from the premium, you then have extrinsic value. So, for example, the call. We had $1.86 was the total premium, but we calculated the intrinsic value as $1.78. So the extrinsic value is simply $1.86 minus intrinsic value, which gives you 8 cents extrinsic. For the put, same thing. We had a $2 actual premium price. We had $1.72 of intrinsic value. So the extrinsic value equals $2 minus 172 or 28 cents. Our extrinsic value on the put is 28 cents. The extrinsic value on the call is 8 cents. Intrinsic value is the easy part. Extrinsic value is not as easy to figure out, and it consists of two more bits of information: time value and implied volatility. The rest of this video will be discussing the basics of time value and implied volatility. Time value is that part of the options premium that is attributable to the amount of time remaining into the expiration of the option contract. This makes sense. The more time you have to watch the stock and hopefully benefit from price movement, the more you have to pay in premium. The probability of reaching your goal is greater if you have 30 days instead of just 1 day to reach that goal. The first thing to appreciate is that time is curved. Time value decay is very rapid near the expiration day, at which point the extrinsic value is 0. Staying with the same example we used previously, we can see that with 75 days remaining before the expiration, the daily decrease or decay in the option premium is about a nickel a day. We're going down about a nickel a day in this area. When we're far out, there isn't a lot of movement. However, as we get closer and closer to expiration, let's say days 35 to 30, we're now at about 7 cents a day. When we get down to day 5, we drop dramatically. We're now 26 cents a day. By days 2 to 1, 35 cents a day. And the last day, all the extrinsic value remaining disappears, which is, in this case, 83 cents. Time is worth money. This chart shows another important point about time. It does make a difference if we're at the money versus in the money or out of the money. Well, this makes sense. When we're at the money, the strike price equals the stock price. If we only have a day or two left in the option, it would be easy to move 1 or 2%. However, if we're already out of the money 5%, 8%, 9%, that's a much bigger move that you're asking the stock to make in that remaining 1 or 2 days. So the premium would obviously be less. So instead of getting 16 cents, we may only get a dime or 8 cents. So at the money versus out of the money or in the money, time value changes. And we get this sort of inverted smile, or other graphs will show it as a smile. And we call that a smile effect of time. So now we're going to move on to implied volatility. The time value was relatively straightforward to determine. It's just how many days to expiration. 1 day, 5 days, 10 days, 100 days. Volatility is not quite so easy. In fact, there's no straightforward method to determine what implied volatility should be. Volatility is a guess on how much the stock price can fluctuate between right now, when you buy or sell the option, and its expiration date. Obviously, the longer you have before the option expires, the more the stock can move up or down. Option pricing is based on the likelihood that the stock will finish in the money, even a little bit, a penny, a fraction of a penny, at the time of expiration. And in other words, it'll have some intrinsic value. The greater the chance that the option will finish in the money, the higher the option price. The more time you have for the stock to move, the greater the odds of success and the higher the price. The greater the volatility of a stock, the greater the price movements of the stock in the same amount of time. Volatility plays a key role in pricing options. So, for a good example of volatility, let's look at two different stocks. We have Coca-Cola and we have CRISPR Therapeutics. Coke is this burnt orange one. And you notice they both start relatively the same price and they're both going to end at relatively the same price. The difference is the journey there. While CRISPR is up, down, dramatically, Coke is taking a relatively straight path. Very low volatility, whereas CRISPR has very high volatility. You could buy it here and sell it there and make a huge amount of profit. However, in the same amount of time, you're not necessarily going to do much with Coke. So, the higher the volatility, the higher the premium. So, what is volatility? Volatility is a measure of risk magnitude, and it does not suggest a direction. This chart shows the effect of volatility over time. At time 0, the price is the price. It does not have any time to go up or down. But as time expands, as we hit 20 days or 40 days, the magnitude of the move up or down increases. Both time and volatility are related. So as you've already seen, time and volatility interact with each other. They're not separate. This graph shows the effect of different levels of volatility. Let's start with 10 days from expiration of the option, and the chart shows a premium at different levels of volatility. The blue line is 50% implied volatility, and it pays about 16 cents at the money, going down, of course, if it's in or out of the money. Then we go to 40%, 30%, or 20% volatility. And you'll see that the volatility changes change the price from 6 cents to roughly 16 cents. You can also see with the yellow line that as you go deeper and deeper into the money or out of the money, that it starts to flatten. Why? Because with the amount of volatility present and the 10 days to go, it just doesn't have enough time if it's already 8% down or 10% to make up the difference and get there. Whereas with a higher volatility, it has plenty of time and it can actually be in the money. This chart is the opposite of the last one. Now let's hold volatility constant. We're going to hold a 20% volatility. We're going to change the time from 5 days to 80 days before expiration. As you can see, with less time, you have less ability to move for an amount like 8 or 9 or 10%. With more time, you can definitely make those moves. And you get paid a different amount of premium. And this makes sense. With only 1 day to expiration, the stock is much more likely to be at the money than if there's 80 days to expiration. Also, the width of the curve is narrowing as time decreases. With just a few days left, you can't possibly move as much as if you have 80 days. As option traders, we can work with two different kinds of volatility: implied volatility and historical volatility. The main difference between the two is that implied volatility is forward-looking, a guess of what might happen in the future, while historical volatility is what really did happen in the past, or statistical volatility. We use implied volatility in a famous equation, the Black-Scholes model, to determine the option premium. Actually, the volatility is determined by the price action of the option. This is completely different from historical volatility. Historical volatility is calculated from past price movement. It is not forward-looking and does not predict a premium for the option. This is the smile of implied volatility. And volatility increases as we move away from at-the-money price. Both in the money and out of the money increases with distance. We're looking at Google. This midpoint is 21.43. That's what it's currently trading at, which puts it right around here. These bands are the bid and ask prices that have gone on throughout the day. This is just for today. And you see the volatility increasing dramatically as we move away from at the money. These price swings, this is where, as option traders, we really make our money in the short term. One more important concept to master: reversion to the mean, or mean reversion. This is a condition when something is overbought or oversold, it wants to return to its average state. In this case, I have a 4 standard deviation regression channel, 2 above, 2 below, and here's the mean of the movement. The stock will vary from the bottom, test the top, come back down. But whenever it moves up or down, its tendency is always to revert back to the mean, or mean reversion. Now let's apply the concept of mean reversion to volatility. This is a chart taken on June 28th of WIN, volatility. The white line is the implied volatility. And again, remember, implied volatility is forward-looking, and it's based upon what the option prices are doing at that moment, the bid-ask spread. So it can be very volatile. The red line is the 75-day historical volatility. This is what actually happened. Prediction versus reality. And as you notice, the predictions will fluctuate, but it always tends to return back to reality. So there's a mean reversion of implied volatility to the historical volatility. The difference between implied volatility and historical volatility gives us a chance to set up a volatility arbitrage. Compare the current implied volatility of the option to the historical volatility of the stock. With high volatility, the premium price will be higher than normal. This allows us to sell the option at a high price and wait for volatility to revert to the mean or expire, keeping all of the premium. On the flip side, if implied volatility is lower than historical volatility, it's a great time to buy the option at a low price and allow it to rise back up to the mean. So, how can we take advantage of volatility arbitrage? Well, this is Chewy, our pet's favorite stock, and it's a real-time trade. This is from my broker, and it's showing the option chain. The implied volatility overall for the stock is 92.5%. Right over here, it shows you the implied volatility at every strike level. These are the strikes. The blue line demarcation is 1 standard deviation, and that's 2 standard deviations of the volatility, the implied volatility. So, for example, at 1 standard deviation, 32.5, it's got an implied volatility of 106%. You can see the farther away we get, just like in the smile, now it's 128% up there. And we compare that now to our probability trader. In the probability trader, we can set different things. I've got it set to Chewy right now. The 3-month annual volatility is 109%. The strike at 12% discount. That's what is this 12% discount for the strike price compared to the stock price is $31.90. And at $31.90, let's say 32, Chewy has 108%. That's really not an arbitrage, but let's use the numbers and see what we have. This, by the way, is a trade I made earlier in the week, and the stock is obviously coming down to me. Probably won't hit me. So, our break-even premium. A break-even premium means this is the amount that you have to make on every single trade just to break even if you sold the stock on Friday. Remember, we're going to be buying the stock. It could be Monday, Tuesday, Wednesday. We're going to let it expire on Friday. We'll be out of the trade. So we need 8 cents per share. Now, the Black-Scholes premium is using the implied or the historical volatility. And it's saying that we need 23 cents. Remember, we said there's really no arbitrage. Our historical volatility, 109%, is pretty much the same, 108% for the implied volatility. And the premium being offered is 23 cents by 24. That's what our Black-Scholes number is. So we don't have an arbitrage, but we could take it because we want to be at least 2 times our break-even premium, in which case right now we're about 3 times. So we do have a trade, just not a great arbitrage trade. The buy and hold B&H plus break-even trade would be 11 cents. This is if you had Chewy over its history. Its profit would give you about 3 cents over break-even per trade. And if we want to make our desired, and we set the number in here, we want to make 20% a year, our desired 20% premium return plus the break-even would mean a trade around 19 cents. So the Black-Scholes premium, 23, is definitely above 19, so we're going to make more than our 20%. So it's still a good trade. And we can go ahead, and I did, take some shares at 32. Now, let me show you another trade that does have arbitrage involved. This is another real-time trade with the SPY. This is done on 6/29/22. The current trading price is $379.47. Overall implied volatility is around 30%. And you see over here per strike level and the different strikes. So where do we want to be? First thing you'll notice is that with SPY, it's not as volatile. Chewy, we're at 12%. So some other stocks will be 20%. With the SPYs, it's only 4%. At 4%, our strike value is close to the lower fence. And in the video regarding the probability trader, I'll let you know what the lower fence is. But we're getting close in there. Plus, we're looking at the number of break-even trades and the sequential trades that would be required. And again, that will be explained in the video on the probability trader. For us right now, the break-even premium is 19 cents for the 368.84. And the Black-Scholes premium is 35 cents. Our 20% desired would be $1, and a buy and hold would be 45. Now let's see what we got. So we go to 368.84. Obviously, they don't have the 84. I'm going to take it down. I want to be extra safe. So let's go to the 368 strike level. The premium, or the implied volatility, is 34.6%. We calculated a historical of 29%. So the Black-Scholes, using 29%, is 35 cents. However, since it's at 34% here, the actual premium is 57 by 58. That's our arbitrage. It's worth 35 cents. They're going to pay us 57 cents. Not quite our desired 20% at $1, but more than buy and hold. So by selling this option, we're making more money than if we bought the SPY and held on to it. Not bad. You can beat the market. So I did take the trade. I bought the option, 368 at 57 by 58, beating the Black-Scholes historical volatility number. Well, that's today's video, an overview of extrinsic value. Time value is a fixed declining value, and implied volatility changes rapidly based on forward-looking trades. When we compare implied volatility to historical volatility, we can find arbitrage opportunities. Watch our probability trader video for details on how to use the probability trader in your everyday trades. Until then, this is Dr. Jim, hoping you have many profitable trades.